Welcome again to our video today. I am Oya Benjamin. We provide you with videos that help you maximize profit and minimize losses. If you are new to our channel, you are welcome. And to those that are already subscribed, we want to say thank you for your trust and thank you for your support. In today's video, we are going to be looking at how to use the previous day high and the previous day low strategy in making the best entry and exit decision in our trading. I won't take much of your time. Stay tuned and don't go away. The previous day high and the previous day low strategy, just like the name sound, involves making use of the previous day high and low to determine what the next day move will look like. Now, for proper understanding of this video, we are going to be dividing this video into two subtopics, which is number one, we are going to be looking at how to use the previous day high and low strategy in a trending market. Number two, we are going to be looking at how to use the previous day high and low strategy in a ranging market. Now, using this strategy, I want you to see the day low as the buy side liquidity pool and the day high as the sell side liquidity pool. Now, if you see them as a liquidity pool, it will help you to understand the strategy and use it in a better way. Also, when I'm using this strategy, I like marking out my 50% Fibonacci level. Now, reason, because I've noticed that sometimes the market starts from the 50% level. Now, after the activity, the whole activity of the day comes back to 50% level to close the day. Now, waiting for the opening of the next day. So with this, it gives me a guideline of where the market might likely start and where the market might likely end. Now, just like the name sounds, previous day. So your analysis should be done using the daily candles. Okay. Now, you look at this chart we have here, you will notice that this market is trending. It's in a bullish trend. Now, looking at this market now, this particular candle here happens to be my previous day candle. Now, what do? I mark out my day high and mark out my day low. Then I also mark out what? My 50% Fibonacci level. Now, once I've marked this out, it will give me a clue. Having in mind, if you look at this, you notice that most of the time, you see, now this one started from the 50% of this, and this started from the 50% of this. So it gives me this mindset that the next candle might start from the 50% level of the Fibonacci, now upward. Now, when you're using this strategy on a trending market, there are two places that you are likely to find your entry point. Number one, on the 50% Fibonacci level. Number two, on the day high, if it is on a bullish trend, and on a day low, if it is a bearish trend. Now, the same thing, just like I've explained on the bullish scenario here, I mark out my day high, I mark out my day low, and I mark out my 50%. So, looking at this now, I know that my entry, the next candle, is likely to open from the 50%. Now, because it is a bearish down movement, I will be expecting a downward movement. So now here becomes my entry. Okay, look at this. Now, this particular point becomes my entry, or below this becomes also my entry. So if I miss this entry, now the next place I'm targeting is below the day low. Now, because I know that the next market will close lower than the previous day market. Now, let's go further as we look at some illustrations. Now, this is a typical market movement, okay, of a bullish day. Now, this particular candle here is a previous day candle, and this is the 50% Fibonacci level. You notice that the new market opened from the 50% Fibonacci level, now tested the day high, came down to balance itself before crossing the day high. Now, once I've placed my entry above the 50% Fibonacci level, where should be my target? Knowing fully well that this current candle must close higher than the previous day close, now my target or my take profit becomes a little bit higher than the close of the previous day. Now, this place now becomes my take profit. Now, where should my stop loss be? Lower than the opening of the 50%. This is my stop loss. Now let's assume I missed the 50% Fibonacci level entry. So where should be my second entry? My second entry will be exactly on this spot, a little bit above the 50%. Okay, that should be my second entry. Don't mind my writing. This should be my second entry. Now, because I know that the market, the current market, will close above the previous close of the other day. So my second entry becomes a little bit above the previous day high. Now let's look at how this occurs on a bearish scenario. Okay, now on this bearish scenario, this chart here, now this is my previous day candle. Now this is the previous day, now the previous day high, and this is the previous day low. Now this one here is my 50% Fibonacci level. Now look at the opening of the new day candle. Now it opened from the 50%, tested the day low, retraces back to balance itself, then it moved down. So just like I said, my entry will be below, a little bit below the 50%. Okay, that becomes my entry, and my target or take profit should be below the day low for my take profit. Okay, now this becomes my take profit. My stop loss should be a little bit above the 50%. So this becomes my stop loss. Now because I know that the market will close lower than the close of this previous day candle, so my second entry becomes at this particular point now to take my profit. Now once I enter from here, now above the day low becomes my stop loss, and somewhere here becomes my take profit. Now I will always advise, if you are making use of the second entry, always maintain your risk to reward ratio to 1:2. Now let's go to the chart as we see how these things play out. Now this is gold USD. Now you look at this market, now you discover that this market is ranging and at the same time is trending. Okay, now this is the previous day high, and this is the previous day low. Okay, and this is my 50% entry. Now I've marked my day high, my day low, and my 50%. Now let's move down to 15% and see how it goes. Now the first thing I want you to know before you make your entry is to know where the market is coming from and know where the market is going to. Okay, so you zoom in the market so that you will be able to see where the market is coming from and where the market is heading to. Now if you look at this particular chart, you notice that this market has been in an uptrend. Okay, and all of a sudden there was a market structure shift that occurred at this particular point. Okay, now giving me a direction that this market that has been in an uptrend will soon start coming down. The next thing is to locate my entry point. Okay, now if you look at this, now you discover that after the market shift, the market will come back to balance every inefficiency before moving that, and that the market has done here and is moving down. So now let's zoom in to see the market more clearer and determine where our entry will be. Okay, now if you look at this, now look at it. Now the market came back here, retested. Okay, now came back here, retested, now making a lower highs and lower low, telling me that the market is in a bearish movement. So where should be my entry? This is my 50% Fibonacci level. This is my previous day high, and this is my previous day low. Okay, now where should my entry be? My entry, you look at this, my entry was below. This is my entry. You can see a sell order here. Now this is where I did my entry below the 50% Fibonacci level, because when I woke up I missed this move, so I decided to enter from here. Now where is my take stop loss? You see, my stop loss was above the 50% level of the Fibonacci. This is my stop loss. Looking at the market, I took 1:3 reward to risk ratio in this market because I am entering using the 50% Fibonacci level. Now let's look at how to use this strategy on a ranging market. Now, this is a typical example of a ranging market. A ranging market occurs when the market is respecting a particular resistance level and a particular support level. If you look at this particular chart, you will notice that this market, they are respecting this support line and this resistance line. And once this occurs, you can say that the market is ranging. Now, so how do I enter my trade? Using the previous day high and low strategy. Now, I want you to understand here. Now, first of all, you mark out your previous day high, mark out your previous day low, and mark out your 50% Fibonacci. Okay, this also can serve as the sell side liquidity, and this can serve as the buy side liquidity. So my entry target here will be the day high, which is the sell side liquidity, or the day low, which is the buy side liquidity. Knowing fully well that once the market tests this support level, it will bounce up, and once it gets to this resistance, it will bounce down. So where should my entry be? Now I will place my entry, my sell entry here, a little bit lower than the day high. Now this is where I will put my sell entry. Okay, now on buy entry, I will put it a little bit above the day low. Now this is where my buy entry becomes. Now if I place my buy entry, where should be my take profit? My take profit should be a little bit below the previous day high. This is my take profit. What if I've placed a sell? Where will my take profit be? Now my take profit will be a little bit above, okay, the day low. Now let's go further as we see more illustrations. Now this is a typical market movement that happens on a ranging day. Now this is my previous day candle. Okay, now on this is my previous day high. Now this is my previous day low, and this particular one here is my 50% Fibonacci level. Okay, now look at the market. The next market opened from here, now tested the day high, moved all the way down here, tested the day low, and closed at the 50%. So my target here should be the pool. This is the sell side liquidity pool, and this happens to be the buy side liquidity pool. So my target here is the pool. I don't have anything to do with the 50% Fibonacci level. Okay, now what do? My entry should be just like I've explained below here. This is where my sell entry will be, and my buy entry will be above the day low. Okay, now where should my take profit be? If I am buying, my take profit will be below the day high. Then if I'm selling, my take profit should be above the day low. And where should my stop loss be? If I place my entry below the previous day high, then my stop loss should be above the previous day high. Now if I place my buy entry above the previous day low, my stop loss should be below the previous day low. Now let's go to the chart and see how this thing plays out on the chart. Now this is Great Britain USD. Now you look at this, you notice that this market has been ranging for 3 days now. And okay, now making 1, 2, 3. You notice that there have been a particular resistance that is placed at this level. Okay, and there has also been a particular support on this level. For the past 3 days now, it has been respecting this resistance and respecting this support level. Okay, so now what do? Now on this, what do? I mark out my previous day. This is the current day that is running as at when this video was recorded. This was the current day and this was the previous day. So what do? I mark out my day high and my day low. Once I am done with marking out these levels, the next thing I do is to move down to a lower time frame. Now let's move down and see. Okay, now just like I've said, now before you enter your position, you should be able to know where the market is coming from and where the market is going to. So you zoom in your chart so that you can be able to see clear picture of where the market is coming from and where the market is going to. Now if you look at this particular market now, you notice that this market has been in an uptrend. Okay, now all of a sudden at this level, the market started consolidating. Now for those of you that have mastered ICT power of 3, I can trade it properly, we know that this is going to be a bearish movement. Now because this happened to be the accumulation and you can see the manipulation here, then after the manipulation we're expecting the distribution. Okay, for those of you that don't know how to use the ICT power of 3, don't worry, in my next video I'll be showing you how to use this ICT power of 3. Now let's proceed. Now this happens to be the previous day high, and this happens to be the previous day low, okay, of the previous day. Now I should place my sell entry below this previous day high, and expect my take profit should be a little bit above the previous day. Now if you look at this market, you notice that this particular market now opened from the previous day low. So assuming I've placed my buy above the previous low, now what happened? You notice that my market will be triggered. By now I would have taken my profit. Now because my profit would have been a little bit below the previous day high, and which was taken. Now this is my entry and this is my take profit. So if you look at this, you discover that this trade was smashed. Now after the market have tested this, it came back again to balance. Okay, now if I have missed this, I will not miss this. I place my entry here and expect my profit somewhere here. I believe that you have learned something from this video. In my next video, I will show you how to make use of a powerful strategy called ICT Power of 3. But before you go, don't forget to hit the subscription button, like and share this video so that it will benefit others. And above all, turn on the notification bell so that you'll be notified when I drop the next video. Thank you for watching, and do have a successful trading week ahead. Bye.